Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we break down the market action today as investors cheer cooling inflation and a trade deal. But does the risk-on rally have legs? We're going to discuss. Plus, we go live to Capitol Hill, where Treasury Secretary Scott Bessent is set to testify before Congress after 2 days of trade talks in London. We break down everything you need to know. And we turn it to the state of crypto and get a read on the recent rally as Ethereum ETFs see record inflows this year. Are investors looking past Bitcoin? We'll discuss that and more on Catalyst. Half hour into the start of U.S. trading, let's get you a check on the markets. Taking a look here at the major averages, you've got them off their session highs. You've still got the S&P up about 0.1%. Not looking like we are in range of those record highs, though we're about 100 points away from those record highs. You're looking for 61.44 on your S&P 500. If we take a look at the individual sector action this morning, it looks like none other than tech leading the gains to the upside in your S&P. We're also seeing that play out in the tech-heavy NASDAQ. Well, let's flip the board over to the bond market, responding primarily to that economic data. You're seeing yields coming in just a bit as the bond market perhaps anticipating more rate cuts to come off the back of that cooling inflation data. And of course, we will continue to monitor that throughout the hour. Well, Treasury Secretary Scott Bessent set to testify in front of the House Ways and Means Committee on Capitol Hill Wednesday. Jennifer Schonberger joining us now with the latest. Hey, Jennifer.
Good morning, Maddie. Treasury Secretary Scott Bessent slipping past reporters into a holding room where he is moments away from entering the hearing room for the House Ways and Means Committee, which is just behind me, where he will testify on the administration's tax and trade policies. In his testimony, he will send China a warning just hours after wrapping talks with the Chinese in London. He says that this is an opportunity for the Chinese to right-size their economy towards consumption and away from production, but that, quote, the country needs to be a reliable partner in trade negotiations. If China will course correct by upholding its end of the initial trade agreement we outlined in Geneva last month, then a big, beautiful rebalancing of the world's two largest economies is possible. Now, the secretary will also tout the benefits of that big, beautiful tax bill, where he will say that it will benefit working class Americans and revitalize the manufacturing sector of this economy. He will tout some details and stats on income that can be raised from the tax bill, saying that take-home pay will increase between $7,800 to $13,300 for the average family of four. He says it will increase wages between $6,100 to $11,600 for the average worker and will cement no taxes on tips, Social Security, and overtime. He also gave an update on tax collections for the tax season so far. He says that receipts are up 9.5% for the month of April and nearly 15% for the month of May, while also cutting $2 billion in waste from the IRS. He called it one of the most successful tax collection seasons in some time. And also on the back of that somewhat cooler CPI inflation report this morning, he says that inflation is showing signs of improvement, chalking it up to the administration's policies, also calling the job market strong. We're just moments away from Secretary Bessent. Back to you.
Jennifer, thank you so much, as always, for your reporting. Appreciate it. I want to bring in our contributor for the hour. We've got Bob Lane back with us. He is Explosive Options technical analyst, a great voice to have when we are looking for clarity in the market, because sometimes when the sentiment gets over its skis, you can bring us back to earth with the technicals. I want to start on the inflation data. We saw the market have a significant move to the upside. We're coming in just a bit off of that. Yep. How would you describe the market reaction?
Quite a bit of a surprise, Maddie. I was looking for a little bit of an increase in inflation over the prior month, over April, and we came in with a 0.1 print on the core number, which is a number that the Fed really pays much more attention to than just the headline number, even though the headline number did come in actually a little bit less than expected as well, 2.4% annualized. I think it's important to recognize that inflation over the last 3 months has been heading lower. Yeah. Just one print is not all that important, but as the Fed has talked about in the past, Chair Powell has mentioned in several of his press conferences, what's important is to pay attention to the trend. And the trend, what he looks at is something like about 3 to 5 months worth of data in a row. So now we have 3 prints in a row. We have March, April, and May that have shown very much lower inflation. Prices are starting to stabilize, which is what the Fed is looking for. I think now that rate cuts are back in the conversation at next week's meeting. And I know some people have already come out and started talking about that as well too. Yeah. But I think it's a serious conversation that the Fed has to have. I think the last projections that they had back in March, Maddie, was for 2 rate cuts in 2025. Yeah. I still don't think that's going to change next week when they set the new projections coming out in June. But I do think that there's going to be a legion of people on the Fed in the voting block of the Fed that's going to start saying, hey, listen, you know what? The proof is in the data here. We've been paying attention to the data. We need to start talking about rate cuts again.
And what's interesting is the economists that we've spoken with throughout our programming this morning have said, look, don't fully trust this because it doesn't have the totality of the tariff policy baked in just yet. But the Fed can't think about the tariff policy impact until it's shown in the data, right?
That's the squishy part of this whole situation here.
Yeah.
When are price increases from tariffs actually going to be reflected in the data? And really, it's hit or miss over here. It could be next month or it could be 6 months from now. So I think that is the reason why the Fed is taking a much more cautious approach as to Fed policy going forward. They don't want to make a policy error here that they can't suddenly walk back. And also, you have to remember that Chair Powell is going to be in the seat for about another 11 months. I think May is his next term is going to be up. And who's going to be in there to replace him with a similar policy that he's got in place?
Yeah, well, it's interesting too that you bring that up because we have some reporting indicating that Treasury Secretary Scott Bessent is being considered by the administration as a replacement for Chair Powell. But that's so far away. It makes me wonder to what extent you think the market is going to focus on who that next Fed chair is.
I also ask, where is Scott Bessent serving the best? Is he serving the best as the Secretary of the Treasury, or is he going to serve best as the Fed chair? I don't know what the answer to that question is, but I certainly think that as of now, for the first 4 months of the administration, four and a half months of the administration, Secretary Bessent has been doing a fine job, at least, if not corralling people around policy with trade and so forth, but also in talking with Chair Powell, keeping interest rates moderate, down 4.5% on the 10-year rate and so forth. He's already stated that, anything above 4.5% on the 10-year is danger zone. So I think that he's serving a little bit better as the Secretary of the Treasury. And I think working together with somebody in the Fed, he has breakfast every week with Chair Powell, right? And so he's working very closely with him. I think they have a good relationship.
Yeah. Well, let's talk about the technicals as I tease, because that is, of course, one of your expertises that we love to tap you for. I mentioned earlier the S&P 500 about 100 points away from its all-time highs. What are you seeing in the technicals that indicate whether or not we're going to get there soon?
Well, we're certainly overbought right now, and markets are somewhat overbought. And we had a strong rally on Monday, and we started down yesterday and rallied back as well too. And we did have a good start to this morning. We are overbought, but now just to understand something. Overbought is just a condition; it's not a signal. And what's the difference? The condition can last for much longer than most people realize or most people expect, right? And so it's not until that condition starts mattering that we have to pay attention to what is the signal. And so we could continue to rise up to new all-time highs, maybe even beyond that, before it actually starts to matter. But I think when we do have that overbought condition, Maddie, we have to take a little pause here, have a little protection on, raise some cash, and do some house cleaning in our portfolios. Wait for that next opportunity to come along, and then if it pulls back maybe 1%, 2%, 3%, or something like that, that's probably our opportunity to get back on board.
Right, buy any dips, it sounds like. Bob, thank you so much.
Right.
We're going to keep getting your insights throughout the hour.
Great.
Really appreciate it. Thank you. President Donald Trump says the deal with China is done, writing in a post on Truth Social, quote, "We are getting a total of 55% tariffs. China's getting 10%. Of course, Trump and President Xi still have to sign off on the deal. Here with the latest reaction to it, we've got our very own Washington correspondent, Ben Merschel. Ben, always great to speak with you. Talk to me about what we know about what went into this deal, given that we are getting any clarity on it from Truth Social posts.
Yeah. Let me address that 55% number first that you mentioned from Trump. So I got a readout from the White House official this morning, and it's gotten a lot of attention this morning, but to underline for folks, it does not appear to be a change in any tariff rates. It was outlined based on pre-existing tariffs that are already in place: 20% on illegal drugs and fentanyl, 10% on the kind of reciprocal Liberation Day tariffs that Trump announced. And then that additional 25% is sector-specific pre-existing tariffs that even pre-exist Trump's inauguration earlier this year, so-called Section 301 and Most Favored Nation tariffs. The important thing on those is those do average out to an additional 25%, but they only apply to certain goods. The overall rate, a kind of blanket rate on China, according to the budget lab at Yale, is about 33%. And it does not appear that was true last week, and it doesn't appear that that's changing based on these talks. What these talks were about this week were kind of a couple, not small, but stumbling block issues that have held up kind of the larger conversations around tariffs. On the U.S. side, it's a focus on rare earth minerals. This is one of China's main leverage points, not just over the U.S. economy, but the world economy, basically how many of these minerals they export and refine. And on the U.S. side, it's export controls, or on the Chinese side, it's U.S. export controls on things like semiconductor design and manufacturing. So what the administration is saying is there is a deal on those two fronts, which could presumably lead to bigger talks on tariffs. We don't have real details on how much give each side gave on those issues. A give on either would be significant for the economy, but it does not address these tariff issues.
Ben, always great to speak with you. Thank you so much for joining us this morning. We got all your markets action ahead, so stick around for more. You're watching Catalysts.
The ARK Innovation ETF soared over the early pandemic, making Cathie Wood a household name. Today, we're going to take a look at how it's performed along with its #1 holding. I'm Jared Blikre, host of Stocks in Translation. Wood's flagship fund, it was founded in 2014, but it really hit investors' radars in 2020, betting big on technology and disruption, major pandemic themes. And as we're about to see, this ETF's fortunes have swung mostly thanks to one single stock, Tesla. Check out this wild ride. All these charts I'm showing, by the way, start right before the pandemic in 2020. ARK skyrocketed from just $33 in March 2020 to almost $160 in less than a year. That's a nearly 400% moonshot. And it was fueled by retail traders with those stimmy checks and meme stock FOMO. It did have some bubble vibes, admittedly, but as the pandemic stimulus faded in 2021, the ETF dropped a brutal 82% from its peak before staging a modest recovery recently. Now notice the number of stocks in ARK, how it moved alongside its price. Into the frenzy of 2021, the ETF bulked up to nearly 60 names, but when the bear market arrived, that number fell sharply. From peak diversification to a tighter core, ARK got leaner as the fund rapidly lost value. But through all this churn, one stock held its place at the top, Tesla. From about $200 million at the end of 2019, ARK's Tesla position soared to $2.4 billion at the peak. Even today, it's the only stock in ARK with a position consistently above $500 million. So it's no surprise that ARK's fortunes are tied to Tesla's. Now, in this chart behind me, you can see the link between Tesla's stock price and ARK's Tesla holdings. But watch this carefully. Even when Tesla's share price was moving sideways recently, its relative weight in the fund continued to grow. Why is this? Because ARK trimmed other positions, increasing Tesla's weight. This shows that it's not just Tesla's price that matters, but also the portfolio rebalancing. And that happens at ARK's discretion on a daily basis. And this final chart drives that point home. Tesla has rarely been less than 8% of the entire fund, but as assets fled, that share spiked, at one time making Tesla 1/6 of the entire ETF, a huge reliance on this single stock. ARK made a name by embracing disruption, but its commitment to Tesla has been a stalwart over this fund's roller coaster ride. Thursday, I'm going to take a look at how the rest of the portfolio has shifted and who could step in if Elon Musk's Tesla truly stumbles. Tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thank you so much, as always. It's time now for today's trending tickers. We are watching GitLab, SailPoint, and Meta. And of course, I have my contributor for the hour, Bob Lane, here to discuss these tickers with me. First up, GitLab shares sinking after issuing disappointing guidance in its second quarter. While GitLab topped expectations in its latest quarterly results with a narrower than expected profit loss and higher revenue, investors are concerned the slowing guidance could signal slowing growth for the software company. And I'm curious, too, we were just talking about some of the software names, but how are you thinking about GitLab?
Yeah, GitLab, unfortunately, is not giving enough guidance to project to a higher growth rate from the analysts. And I saw that a lot of the analysts have really cut their price targets significantly on GitLab. Stock's getting pounded today here, and as the rest of the market is up. So you have to really pay attention to that relative strength. It's very poor today. And then also revenue numbers, just not enough to justify a high multiple for this particular company. It's in a high growth area with Salesforce and some and Workday and so forth, some of these other competitors. But they're taking some share from GitLab, and I think GitLab's story was about a year ago. They were very, very strong. They had some really good growth, but I think that's been stunted for the past couple of quarters.
Yeah, really great overview there. Let's talk now about SailPoint. Shares jumping after topping Wall Street's estimates in its first quarter and lifting its full year guidance. The company's seen strong demand for its cybersecurity products, bucking the trend of disappointing results from competitors in the industry. And you can see those shares up over 19%. What is SailPoint getting right that others are getting wrong?
Big number here is called the ARR, or the annual recurring revenue, and that's up 30% going forward. So $900 and something million of annual recurring revenue, which is real strong for this company. It's the biggest backlog they've had in the history. So I think that SailPoint has it's got wind in its sails. Sorry about that, but it's very, very strong name over here. It's been strong for quite a few months over here. The technicals are also very, very positive on SailPoint.
Yeah. Well, finally here, let's talk about Meta closing a deal to invest $14 billion into Scale AI and hire the company's CEO, Alexander Wang. This is according to reporting from CNBC. Now, this is part of Mark Zuckerberg's efforts to boost Meta's standing in the AI arms race. Historically, it's been seen as a little bit on the back foot when you compare it to the likes of Microsoft, obviously having the OpenAI investment. How much does this position Meta as an actual leader in the AI race?
Really love this move by Meta. It's really a fantastic move. I think there were a couple of other big companies like Microsoft and Google that were also looking at Scale to purchase, but they managed to pull this one off. $15 billion is not a cheap price tag, but especially for a company that's not making any money. But still, I think that if you look back at the track record of Meta over the years, when some of their acquisitions, if you go all the way back to Instagram, go back to WhatsApp, some of their strategic acquisitions have been fit their initiative for that time when they were being bought. I think this one is going to be one, probably two, maybe three more acquisitions by Meta for their AI initiative. I think it's going to be very strong, and I think that once again, Mark Zuckerberg is going quickly to make sure that they grab their share of the market before it gets diluted.
Yeah, and also we're seeing some quantum stocks moving to the upside today off the idea that maybe they'll get acquired someday as well. So interesting to monitor. Thank you so much, Bob. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Meta could pay nearly $15 billion for stake in Scale AI, according to a report from The Information, as the company looks to expand its AI ambitions. Joining me now on this and more, Jeetu Patel. He is Cisco's President and Chief Product Officer. Great to have you on this morning, Jeetu. The latest AI investment from a tech company with regards to Meta. How are company leaders thinking about AI expansion right now, and are you looking at any potential acquisition opportunities in a similar manner?
Madison, it's great to see you. And, this is such a accelerated time for innovation in the industry, where if you think about what's happening, we're moving in AI from this kind of interactive mode of asking a question to a chatbot and intelligently getting an answer, to now moving into this agentic era where agents are going to be able to autonomously, complete tasks and jobs. And that's going to have a very different level of, appetite for infrastructure, whether it be compute, power, networking, security. Those are going to be pretty important underlying kind of, infrastructure components to power this movement. So we are seeing a fair amount of innovation across the board. We are pretty heavily invested in the AI industry. We're actually making sure that, we've had strategic investments in multiple different companies. And we just, about a year ago, made sure that we had a great acquisition with Splunk, which is going really well. And then there's a ton of innovation that's going on. So right now, I'm tuning in from San Diego, where we have 22,000 of our closest customers that we announced the largest innovation payload in the history of the company yesterday. And the reaction has been palpable because there's so much innovation that customers are starting to do to make sure that they stay relevant in this AI movement.
Yeah, and Jeetu, you have obviously been consequential in the company's sort of 2-year turnaround plan, or re-innovation plan, I should say. And it's been interesting, as someone who talks to investors a lot, to hear them go from describing Cisco as a pure software name to describing it as an AI stock. What are you going to do to continue that momentum, to make sure that investors still see you as an AI play?
The easy answer on that one is you have to keep innovating and staying a step ahead of the market. And we are lucky in the sense that the natural appetite with this agentic era that we're moving into is that there's going to be a demand for two things that we have in spades. The first one is low latency, high performance, power efficient networking. And then the second one is safety and security, so that we can make sure that we have security becoming an accelerant for adoption in this market. Because right now, if you don't establish trust with the user, they're not going to use AI. So this is a prerequisite for AI as we move forward. So those are the two areas that we happen to be among the largest in the, we're the largest networking company in the world. We're one of the largest security companies in the world. So it happens to be that we've got the core foundation of the technology to continue to fuel this movement.
And Jeetu, I've heard you talk about how we are still just in the early innings when it comes to AI, that will move to more of an agentic AI workforce even going forward. Talk to me about how you are thinking about AI reshaping the labor market going forward here. To what degree do you see replacement of jobs, and how do you think the economy could potentially respond to that as well?
In any such disruption and replatforming that happens, there's going to be some jobs that change, but I don't worry as much about AI taking jobs. I worry about people that use AI better than someone else actually being the right people for the job. And so, if you look at the agentic era, there's a couple things. Firstly, I would urge people to worry less about AI taking the job, but think about all the areas where we don't get to because we just simply don't have time. This agentic era is going to actually augment capacity so that we can do things that we weren't able to do because we couldn't get to it. And number two, there's going to be certain things that machines do really well, which then allow us to do things at a higher order. So I'll give you an example. Coding is one of those examples where the way that coding happens today and the way that an engineer spends their time might be very different from the way they spend the time in the next 3 years, because you'll actually see that there'll be autonomous code written, but that doesn't mean that we don't need engineers. It just means that engineers don't need to specialize a certain percentage of the time on syntax, and they can specialize on higher order bits.
And it makes me wonder, too, about when we talk about your expansion plans, about the partnership with NVIDIA, a move to be able to create this kind of unified architecture to simplify the build out of AI-ready data center networks. To what degree does that partnership with NVIDIA allow you to sort of own the networking required for AI? And do you see Cisco as the leader in that move?
So I'm biased, and I definitely do. But if you think about the way that this market's evolving, is there's an ecosystem of providers. It's ourselves, it's NVIDIA, it's OpenAI, it's AMD, and we all kind of work together to make sure that we can build out these very large capacity data centers that are happening all over the world. Frankly, wherever there's availability of power, you're seeing these data centers, and it'd be great for having American companies be the ones that are powering and fueling these data centers. And so we happen to be one of them. We happen to have, at scale, one of the most credible businesses for the data centers. And I was just in the Middle East, Madison, just a couple of weeks ago, and we announced partnerships with the Humane Project, which is Saudi Arabia's project for their initiative for doing data center build-outs. We also announced a partnership with G42, which is the United Arab Emirates and Abu Dhabi's effort to do the same. We've announced a partnership with Stargate UAE. So you could start to expect us to be more and more present in all of these data center build-outs because there's so much appetite for networking. These AI workloads are network hungry. And if you actually delay the packet getting from point A to point B, that actually keeps the GPU idle, and that's not a good thing. And for both training and inferencing workloads, you tend to have a fair amount of demand for high speed, low latency, high performance, energy efficient networking.
Jeetu, great overview, and congratulations on the new role as well. Our first time speaking with you since that promotion. Really appreciate your time this morning.
Thank you so much for having me.
Coming up here on Yahoo Finance, Treasury Secretary Scott Bessent testifying before the House Ways and Means Committee. We're bringing you expert analysis of the Treasury Secretary's commentary next.
Deals to bring down tariffs, non-tariff trade barriers, which the academic research has shown to can be even more pernicious than the tariffs, currency manipulation, and the subsidy of labor and industry. But as these countries come to us, and I look at the list, and I think, how could this have happened? How could this have happened? That the United States willingly...
That was Treasury Secretary Scott Bessent testifying live before the House Ways and Means Committee. Secretary Bessent issuing a warning to China, asking the nation to be a, quote, reliable trade partner, and voicing support for the GOP-driven tax bill. Joining us now with the biggest takeaways from the Secretary's testimony, we've got John Hilsenrath back with us, StoneX's senior advisor. Great to speak with you again this morning, John. What are your biggest takeaways from listening to the Treasury Secretary's remarks this morning?
Well, I think the Treasury Secretary is going to be taking some victory laps on a few fronts. That the relationship with China seems to have stabilized, with both sides reaching an agreement to revive rare earth mineral exports, tariffs stabilizing. He's going to be talking about tax revenues coming in better than expected, despite cuts at the IRS. And I think really importantly, we got good inflation news today, a very modest CPI report, which defies a lot of warnings that economists have made that tariffs are going to lead to rising consumer prices. We haven't seen it in the data yet. So I think Scott Bessent has some good news to lean on in his testimony.
Yeah, just looking at some of the headlines that we're getting in here too, John, I wonder to what extent you think that Congress is going to push back on Section 899 within the tax bill. Of course, this has been a key focus for investors, the idea that any countries that have something the administration would think are unfair trade practices may be more heavily taxed for their U.S. investments. And of course, typically you want to encourage investment in the United States. To what degree do you expect to get any clarity or commentary from the Treasury Secretary on that?
I think we'll get some signs of flexibility while lawmakers hash these details out. I think what the Treasury Secretary demonstrated in April is that he's very focused on averting foreign investors selling U.S. Treasury bonds. So when we saw 10-year Treasury yields rising in April, as a result of the tariff wars, as a result of threats to fire Jay Powell, he convinced the White House to back off on some of these threats. And so the provision you mentioned is another area that might frighten foreign investors. And I think he doesn't want to do that because he doesn't want to raise the cost of capital in the United States.
Yeah, and it makes me wonder, too, just more broadly about the Treasury Secretary's commentary on the tax bill. He's obviously been putting forward the idea of the thousands of dollars that, in his view, the tax bill would save Americans. Can you just give me your context on that, John? How are you thinking about how this tax bill could impact consumers who are feeling the impacts of inflation, despite the fact that it came in cool this morning, but who have been talking about kind of this vibe session for so many years?
Well, to me, it comes back to what I was just talking about, which is long-term interest rates. So what really matters to me in this bill is the deficit, the budget deficit that lawmakers are encoding for the next 5 to 10 years at least. The average deficit, the average federal deficit over the last 100 years has been about 2.5% of GDP. It's been 6% since COVID. And this budget the Republican lawmakers are working on right now would increase the deficit to more than 7% of GDP. And I think the real risk for the average American from this is that it pushes up long-term interest rates. It pushes up the cost of an auto loan. It pushes up the cost of a mortgage. It pushes up the cost of getting into your own home or getting out of a home and moving up. And so I think that's something that the Treasury Secretary has to be very wary of. Now, that runs into politics, really. We see that, for instance, with blue state Republicans in New York, California, wanting to dial back the SALT tax, which is a costly endeavor. Spending cuts, not willing to touch Social Security and Medicare. So in order to get this bill done, it seems like they're going to have to agree to doing it on the back of large budget deficits, which could cost households in the long run.
And John, we all love to get your take on the Federal Reserve. How are you thinking about how the tax bill could impact the inflation picture in the U.S. if it is supposed to be such a cushion to Americans' wallets at a time when the Fed is trying to fight inflation and potentially that being driven by more consumer spending?
Yeah, well, I mean, you make a good point. So a budget deficit of 7% of GDP is a massive amount of stimulus going into the United States economy. That's more than $2 trillion a year of borrowing and spending in excess of revenues. So I think from the Fed's point of view, they've got to be asking themselves, do we really want to lower interest rates when there's so much fiscal stimulus pumping into the economy? I think that's one of the sources of caution for the Fed as they consider how much lower they want to push short-term rates.
John, always great to speak with you. Thank you so much for your insights this morning. Let's dip back into Secretary Bessent's commentary.
Sorry, I chuckled when you talked about the IT at the IRS. The program is 35 years behind schedule. 35 years. And is wasting $2 billion a year.
That's why we put the extra money in, Mr. Secretary.
No. The extra money went in for bodies, and whistleblowers acknowledged that standards were being lowered to bring in new agents. The money is not the issue here. It is how the money is spent.
Equity funding in fintech has fallen off after surging in 2021, but showed signs of stabilizing in the past year. So what's next for the industry? Joining me now, Nigel Morris. He's the co-founder of Capital One and co-founder and managing partner of QED Investors, a fintech VC that's made unicorn investments in the likes of Credit Karma, Nubank, SoFi, and Avid Exchange. Nigel, it's great to speak with you. Thank you for making the time this morning.
Good morning. Pleasure to be here.
Talk to me about what you are seeing in terms of what is next for fintech after that, big surge in popularity that we saw in 2021. What's going to lead to the next growth area?
Yeah, we've just published our third annual study that we do with our friends at the Boston Consulting Group. And it says that fintech is alive and well. Fintech is only 3% of total financial service revenue worldwide. Mm-hmm. So it is about 380 billion on 14.5 trillion. Yeah. And what we have is fintechs now coming of age, a new generation of fintechs that are going public, many of them as we speak. And we're seeing them starting to dominate certain spaces, whereas where banks have decided not to play or can't play. So buy now, pay later, earned waged access, digital brokerage, money movement across border for consumers and small businesses. These are segments now where fintechs have developed significant moats and are growing really fast. Fintechs grew last year at 21%. The incumbent population grew at 6%. Yeah. At that rate of difference, over the next 10 years, fintech's penetration will go from 3% to about 10%. So fintech is here, alive and well, and in many places outcompeting the incumbents.
Well, to that point, and why you're such a great person to speak with is because you understand the incumbents as the Capital One co-founder, of course, and you've made this transition. I saw a stat recently indicating that young people inheriting wealth, almost the overwhelming majority, expect to move out of the traditional bank and move their family wealth into a fintech firm. What does that signal to you about the appetite, specifically amongst younger people, for where they want to put their money?
You mentioned Capital One, and I must say that it's been 30 years since Rich Fairbank and I took Capital One public, and what a journey that has been. And for Capital One, which I think was the first real fintech. Now, yeah, indeed. I mean, culturally, philosophically, it came out of nowhere, and we built this juggernaut. Now, Capital One, with the acquisition of Discover that just got a green light, is now the biggest credit card company on the planet. It's very special to have been part of that with my friend Rich Fairbank. So I think what we see is a generation now of consumers who are digitally native, who don't feel the loyalty that may have existed to the incumbent bank, certainly not the incumbent bank distribution channel, which is branches. And candidly, I think so many banks confuse inertia with loyalty.
Explain that.
In that, it's not easy to move your checking account, your current account, from bank A to bank B to bank C. In a world where we are going to see these AI agents, and in a world where open banking gets more traction in the US, it's going to be easier and easier for people to be able to shop across financial service providers. Now, I philosophically believe that unless there's a good reason, consumers will fragment or modularize their banking and financial service relationships. They'll have a brokerage account, they'll have a checking account, they'll have a CD here, they'll have a credit card here, they'll have a mortgage here, rather than bundling it together. And I think that we're going to see the fintechs cherry picking best customers and best product away from the incumbents.
Right, you may have your high yield savings account where you can get the best yield, but then keep your checking elsewhere and kind of shop around for those services.
Particularly if the product is largely a commodity. And has not been tailored to you, right? I mean, I think the incumbent population, the banks and insurance companies are not really good at figuring out what unique product will sing and work for a unique individual or small business.
Well, what do you think is the best product for a fintech to offer right now?
Well, I think that you'd want to go to where you think the economic rents are really good, where the unit economics are terrific, where consumers are willing to buy the product online and to do it digitally. For instance, annuities and mortgages are much harder because they're much more complicated and require, have much bigger stakes for the individual. So look, I grew up in and around lending. Many of QE, we've made 200 investments and invested in nearly 30 unicorns over the last 20 years as fintech specialists. I constantly zero back into lending and into consumer lending. And I'll give you one stat that just, because I was in Mumbai just a couple of weeks ago, there are 80,000 Indians, 80 million Indians now that make more than $10,000 a year. And on a PPP basis, purchasing power parity basis, it's 3.5 times that. 3% credit card penetration in India.
Wow.
So there's an opportunity. So I think consumer lending, if done well, is fabulous. Capital One built a juggernaut on that, and I think that's a place that I often go to.
I want to end with something you mentioned at the beginning, buy now, pay later, which is something that obviously fintechs have the capabilities to do. But I have heard some people say that the existence of BNPL is part of what makes them skeptical about switching to a fintech. They like the idea of the more traditional banking model that doesn't play with anything that may be perceived as risky through BNPL. What do you make of that?
Well, buy now, pay later is it in itself is not a massive innovation. What it is pay for a product digitally online that you were going to go to buy over 2 or 3 installments. That's what it is. Now, what we found is that the massive ascension of Klarna, which was a QED investment, we see here in the US Affirm, and we don't see the banks really playing in the space. It meets the need of
Is that not because the banks think that they shouldn't be playing in that space?
It's a really good question. I think that it depends on which bank you talk to. Some banks would say, this is not something we want to do. It feels kind of tawdry, and it's focusing on a population that we don't really, I mean, look, if you have a FICO score under 650, and by the way, Credit Karma was a QED portfolio company, and they now have 120 million customers, and they democratized access to credit bureau data. If you have a FICO score under 650, you're not very interesting to the Main Street Bank. We don't really want to lend money to you, and it's 40% of America. We don't want to lend money to you. You probably don't have a lot of money, so your deposits aren't worth very much. And the chances of you wanting access to a mortgage anytime soon is low. So there's a question mark about whether or not the incumbents really missed buy now, pay later. Yeah. And now you have Klarna and Affirm who've got incredible moats, or whether or not they steered away from it. Probably a bit of both and depends on the bank. But I think it speaks to something much deeper, and that is culturally, banks are designed to defend themselves, to stay around, to make sure they don't make mistakes. And fintechs are the innovation platforms. It's no surprise that earned wage access, buy now, pay later, money movement across border, eToro and Circle in money management. This is where the innovation is occurring. And I think banks have to say, look, we've got these marvelous experiments going on in real time. How do we partner? How do we buy? How do we learn from this incredibly innovative ecosystem that exists around us?
Nigel, a great conversation. Thank you so much for your time. Really appreciate it. Thank you. Coming up, Ethereum ETFs pulling in record flows. That's coming up next on Catalyst. Just under a year after being approved by the SEC, Ethereum ETFs had a record 7th consecutive week of inflows, bringing in $326 million in the past week alone. To break down the risk-on rally, I want to bring in Kristen Myers, ETF.com's SVP of Content and Editor-in-Chief, for this week's ETF report, brought to you by Invesco QQQ. Great to have you this morning, Kristen. Talk to me about what the inflows into these ETFs are indicating to you about risk sentiment.
Yeah, so frankly, people are being very risk on, particularly when it comes to cryptocurrency. And that's because the SEC has made some comments lately, all in regards to cryptocurrency staking, where folks can essentially allow their cryptocurrency to earn rewards for them by validating either the Ethereum or Bitcoin networks. Now, it was unclear what the SEC and what regulators were going to say in regards to staking, particularly when it comes to these ETFs. But it seems that the SEC might actually be pretty favorable towards staking. And that is why we're really seeing a lot of these crypto ETFs, particularly around Ethereum, really pulling in a lot of money. Now, you kind of mentioned broadly, we've seen 326 million of inflows into Ethereum ETFs or into Ether ETFs. ETHA, that is the iShares Ethereum Trust ETHA. It pulled in over 300 million of that 326 million just last week alone. And so really a lot of folks are piling a lot of money into, particularly again, that Ether ETF, as they're really wanting to be risk on when it comes to cryptocurrency. And they're also seeing a little bit of grabbing some of the outflows that we saw from the spot Bitcoin ETFs. That has been moving over to Ethereum. Again, Ethereum really becomes a sort of mainstream crypto asset.
And to what degree do you expect those flows to continue going forward?
Yeah, that's a really, really good question, because what we're seeing with cryptocurrency is a little bit interesting. These are not assets that are totally mature, and there's a lot of questions how these assets are going to perform in a portfolio. For example, when it comes to Bitcoin, there's still a question of whether it is digital gold, for example. And as we see a lot of volatility in the markets around trade and around inflation, recession risk, and the Fed, investors really need to decide how they want these assets to perform in their portfolio. And that question, or rather the answer to that question, will really truly decide how we're going to see the inflows into these assets either continue. Now, I will say this. We are continuing to see the inflows into these assets, particularly as these assets continue to grow in terms of value. So I don't see this trend happening anytime soon, but I do think it will be a little bit of a roller coaster ride for investors going forward.
Kristen, really great overview. Thank you for making the time for us this morning. And a big thanks to Bob Lane, Explosive Options technical analyst, for joining me for the hour. Really appreciate your insights this morning, Bob. Thank you.
Great to be with you, Maddie.
Thank you so much. Coming up, we got Wealth, dedicated to all your personal finance needs. Brad Smith has you for the next hour, so stay tuned for him next.